Hey everyone, and welcome back to India Explained. We're here to make your money make sense.
Absolutely. And hey, if you want to keep making sense of it all, do us a little favor. Go on and hit that like button and definitely subscribe so you never miss out on our chats.
Okay, so let's get right into it. The stock market, right? It's hitting new highs practically every other day. You hear about the Sensex, the Nifty, everything's just going up and up. And that brings up a really common question. What on earth is an investor supposed to do right now?
Man, you're telling me. That is exactly what's been bothering me.
Yeah, I've got to be honest, the FOMO is real. It's hitting me hard. My WhatsApp group is just exploding with friends talking about the crazy profits they're making. Every single day, someone's posting a screenshot. And I'm just sitting here feeling like I'm the only person missing this massive party. Should I just, I don't know, put in a lump sum right now and get in on the action? I totally get it. And trust me, you are not the only one feeling that way. That FOMO you're talking about, it's probably the biggest emotional trap for any investor. See, when the market is flying high like this, our decisions get hijacked by two really powerful emotions, greed and fear. Let's break down why that's such a risky combination. You know, what you're describing actually has a name. It's called herd mentality. It's this feeling where you see everyone else buying, so you feel this crazy pressure to do the same thing, right? Without even stopping to ask yourself, hey, is this the right move for me and my goals? You're basically just running with the crowd, but you have no idea where you're all headed. Okay, that makes sense when everything's going up. But what about the flip side? You know, when the market starts to crash and everyone is selling, isn't that the smart move then? I mean, to get out before you lose everything? It is just terrifying to see your whole portfolio turn red. Right, and that's the other emotional reaction, pure panic. But let me ask you this. When your favorite clothing store has a massive 50% off sale, do you run away from it, or do you rush in to buy more stuff at a great price? A market fall is exactly like that. It's a retail sale for stocks and mutual funds. Every single rupee you're putting in through your SIP is now buying you way more units. So panic selling? It's like sprinting away from a huge discount.
And look, that fear isn't coming from nowhere. Market falls can be absolutely brutal. To give you some perspective, back in the 2008 global financial crisis, some small cap funds here in India, their value dropped by a mind-boggling 68%. Just imagine, you invested 1 lakh rupees, and you look at your statement and it's suddenly worth just 32,000. That is tough to handle.
So here's the real takeaway from all this. On paper, if you look at a spreadsheet, the math of long-term investing always works out. You stay invested, you average your costs, you make money in the long run. But the real fight, it isn't with the math. It's with your own mind. It's all about psychology. It's having the guts to see those scary negative numbers and still stick to your plan. And all of this brings us to the second huge trap that investors fall into, especially when the market feels this exciting. And that's the temptation to look for shortcuts, to try and make a quick buck. Wait, but what if I'm clever about it? Can't I just, sell everything when the market seems to be at its absolute peak and then just wait and buy it all back when it hits rock bottom? I mean, that sounds like a perfect strategy, right? Ah, yes. The classic timing the market dream. If only it were that simple. The truth is, even the biggest, smartest experts on the planet can't predict the exact top or the exact bottom of the market. Most people who try, they just end up selling way too early and then buying back way too late. They actually lose money. It's like Warren Buffett famously said, the stock market is just a way of moving money from the impatient people to the patient ones. And a mistake that goes hand in hand with this is what we call performance chasing. You see a stock that shot up, say, 100% last year, and you immediately think, wow, this is the one. So you dump all your money into it. But you have to remember, the market moves in cycles. The superstar stock of today can very easily be tomorrow's biggest loser. Okay, I get it. No time in the market. But what about all those finance gurus on YouTube and Instagram? The ones giving out stock tips. Some of them are even promising guaranteed returns. Can I just follow their advice? I mean, they seem to know what they're talking about. Finance Guide, you're talking about finfluencers, financial influencers. And you're right, they've become a massive source of information, especially for younger investors in India. Now, while some of them do provide some good, basic educational content, you've got to be aware that there is a very risky side to all of this. Yeah, you really have to be careful, because there are some serious dangers involved. SEBI itself has pointed out some major red flags. For one, a lot of these finfluencers have no official qualifications. Worse, some are caught up in pump and dump schemes. Basically, they'll hype up a stock, get everyone to buy it, using that very same herd mentality we talked about, and then they sell all their shares, causing the price to crash and leaving everyone else with losses. There is pretty much zero accountability.
So listen, here's a super simple golden rule. Anyone, and I mean anyone, who gives you specific investment advice, like telling you exactly what stock to buy or sell, must be registered with SEBI. If they're not, you need to be extremely cautious. It's a really simple check that could save you a world of pain. Phew. Okay. This is a lot. FOMO, panic selling, finfluencers. My head is spinning a little bit. It's all just a bit overwhelming. So what am I actually supposed to do? Can you just give me a simple plan? A no-nonsense playbook I can just follow?
Of course, let's make it super simple. Here's a 4-step playbook anyone can follow. Okay, step 1, have clear goals. You need to know why you're investing. Is it for a down payment on a house in 10 years? Or is it for retirement in 30 years? Step 2, diversify. It's the oldest rule in the book for a reason. Don't put all your eggs in one basket. Step 3, be patient and systematic. This is where your SIP becomes your absolute best friend for long-term investing. And finally, step 4, and this is maybe the most important one for today's topic, ignore the noise. Tune out the tips, the rumors, the panic. Just stick to your plan. And to make it even simpler, here are the absolute don'ts straight from SEBI. Don't get suckered in by rumors or flashy ads. Don't invest just because the market is on a bull run. And the golden rule we already talked about, never, ever, ever deal with an unregistered advisor. So, at the end of the day, it really all boils down to this one simple question you have to ask yourself. What's my goal here? Am I in this to patiently build wealth for my future, for my family, or am I just chasing the short-term thrill of quick profits? Your honest answer to that question is going to guide every single decision you make from here on out. Finance Guide, I really hope that helped clear things up a bit. You see, investing doesn't have to be this big, complicated, scary thing if you just stick to the basics.
Curious friend? It really does. Thank you so much. And hey, for everyone watching, if this chat helped you out, make sure you are subscribed to India Explained. We have simple chats about money just like this all the time. We'll see you in the next one.